Good afternoon, everybody. Welcome to the second seminar organized by Mercury Partners Academy and University of Padua in the course of Advanced Topics in Banking. This is the part of the course taught by myself, Marcello Zanardo, adjunct professor and CEO of Mercury Partners Academy. And we have the pleasure of having with us today Mr. Silvio Olivero, who is the head of research and equity manager at Giotto Cellino SIM. Silvio's got a very long experience in the financial markets. Today, he will tell us how to use these tools to compare financial markets, mainly the equity markets, but not only. Silvio is based in Turin. As I said, he's got a lot of experience. So Silvio, welcome. Thank you to you. Thank you to Giotto Cellino, and over to you.
Thank you, Marcello. Hello, everyone, and thank you for having me here today. Well, my goal today is to introduce you to a market valuation metric called CAPE ratio. CAPE stands for Cyclically Adjusted Price Earnings. I will also explain the excess CAPE yield, a measure of the equity premium can be derived from the CAPE. Let's begin with the end. This table, which we will analyze later, is a useful tool to guide investors in strategic asset allocation choices. By strategic asset allocation, I mean portfolio decision with a time horizon of more than 5 years and close to 10 years. The primary goal of this presentation is to introduce and clarify the concept presented in this table. By the end, you should be able to create a similar table and interpret the data that it contains. You can go on. Well, since the CAPE is essentially a PE ratio, a price earnings ratio, calculated using a specific methodology, we can start with some general consideration on the PE ratio. The PE ratio, calculated for a single stock, is given by the current stock price divided by the so-called earnings per shares, EPS. That is simply the total earnings achieved by a company divided by the number of stocks. Example number 1 illustrates what I mean. If a company makes, example, a profit of 5 million euros and its capital is divided into 10 million of shares, its EPS will be 0.5 euros. Finally, if the share price is 10 euros, the PE ratio will be equal to 20. But PE ratio can be read in a straightforward way. Answer this question: how many years it takes to recover through earnings the price I'm paying today for the stock? In the case of example number 1, the answer to the question is 20 years, since the annual profit of 0.5 euros, it will take 20 years for the sum of annual profits to match the current price of 10 euros. Obviously, the assumption here is that future earnings will be the same you have used to calculate the ratio. This means you must rely on a recurrent earning, or in other words, a measure of profit considered normal. As we will see later, this assumption has important consequences in the calculation of the ratio, and we will introduce a simple but powerful way to assess normal earnings for a stock, but also for an index. And let's talk about indexes. It is also possible to calculate PE ratio for a stock index. Stock indexes are nothing more than portfolio, which contain a certain number of shares. In the simplest indexes, called capitalization indexes, each share appears in a quantity equal to the total issued. There are more complex indexes in which the shares are weighted, for example, on the basis of free float, but for other purposes, it is sufficient to consider an index weighted on the basis of capitalization. Therefore, if you want to estimate the P/E ratio of an index, you just have to divide the sum of capitalization of all stocks by the sum of total earnings achieved by the companies in the index. Example number 2 express what I mean in the case of a simple capitalization index composed of 3 companies. Calculating the P/E ratio for a stock index is equivalent to aggregating the companies in the index into a single large company whose market value is equal to the sum of the individual capitalization and whose profit corresponds to the sum of individual profits. Well, it follows that in the case of an index, the procedure is reversed compared to what applies to a single stock. First, you have to calculate the P/E ratio as described, and then the EPS can be derived. So, for example, if the P/E ratio of the S&P 500 index calculated as described turns out to be around 25, given that the index today is trading at around 6,000, we can deduce that the EPS of the S&P 500 now is about 240. Well, with this way I described of calculating the ratio, the P/E ratio for an index creates some problems when one or more companies within the indexes make losses. In fact, losses affect the sum up to the limit of making it negative and can determine paradoxical outcomes. Negative earnings deprive the P/E ratio of meaning. For this reason, data providers like FactSet or Bloomberg generally produce 2 estimates for P/E ratio of indexes. One that takes into account losses and the other that excludes them from the calculation. To fully understand of the meaning of the P/E ratio, we must start with the dividend discount model. Formula 1 represents the DDM, the dividend discount model, in its standard formulation that defines the fundamental value of a stocks that I have named P0 as the present value of future never-ending dividends. The discount rate that I have named R in the formula is the required rate of return from stock investing. Through a few additional assumptions described in the text, it is possible to derive Formula 3 from Formula 1, where R in Formula 3 now be understood as the expected return on the investment rather than the required return. And it is decomposed in Formula 3 in its 2 essential components: the dividend yield and the capital gain. Indeed, P0 now is to be interpreted as the market price of stocks, and the ratio between the dividend and the market price represents the dividend yield. Meanwhile, G can be understood as the expected price appreciation of the stock, assuming a constant dividend yield. In fact, if dividend yield remains constant, the stock price will increase over time at the same rate of the dividend. Okay, thanks to some further hypotheses that you can read at page 9, it is possible to write Formula 6, from which can be deduced that the expected return from the equity investment is equal to the inverse of the P/E ratio, the EP ratio, that is often named earnings yield. This is the most important information provided by P/E ratio. It is the inverse of expected return obtainable by investing in stocks. Well, Formula 6 provides some justification for a model. Yes, 9, I think, okay. Formula 6 provides some justification for a model known as the Fed stock valuation model, which was quite popular until a few years ago. The model defines an extremely simple condition of equilibrium in the financial markets, which is presented in Formula 7. The model uses the earnings yield, EY, as a proxy for expected return on stocks, and the 10 years nominal treasury bond yield to maturity, that in Formula 7 is indicated as TBY, as a proxy for the expected return on bonds. As shown in Formula 7, the markets are in equilibrium when earnings yield equals treasury bond yield, meaning that the expected return on bonds matches the expected return on stocks. This leads to two clear implications for stock and bond market. When earnings yield exceeds treasury bond yield, the stock market is considered more attractive than bond market. When treasury bond yield exceeds earnings yield, the bond market is considered more attractive than stock market. As I mentioned, this simple rule of thumb enjoyed a certain level of popularity, also because its application was quite profitable in the past. However, the model is wrong. There are two mistakes in the model. The first is straightforward. Investors generally demand a risk premium for holding shares. Therefore, the equilibrium between the stock and the bond market should not occur when earnings yield equals treasury bond yield, but rather when earnings yield exceeds treasury bond yield by the amount of the risk premium. The second mistake is less obvious and arises from the fact that treasury bond yield is a nominal yield, while earnings yield is a real one. What is meant by real return and nominal return? What distinguishes these two types of return? A definition that seems simple and effective to me is that a nominal return is affected by inflation, whereas a real return is not affected by inflation. It can be demonstrated that the earnings yield is a proxy for the real expected return on stocks, not for the nominal. And in the text, I attempt to provide a more formal proof of this statement. For the moment, I will present only a few empirical observations that support it. And we can go to 11. Well, the chart refers to the US market over the past 20 years, during which long-term inflation expectations, recorded monthly, were grouped into categories. The histograms display the average yield of the 10-year treasury observed for each inflation expectation category. Thus, the first histogram represents the average yield of the 10-year government bonds observed when inflation expectations were below 1.5%. The second represents the average yield of 10-year government bonds observed when inflation expectations were between 1.5 and 1.75%, and so on. As shown, the yield on the US 10-year treasury, being a nominal variable, is positively correlated with inflation expectation. The higher the inflation expectation, the higher the yield required on treasury bonds. In the second chart, you are now seeing, using the same classification of US inflation expectation and observing the same time period, obviously, the histogram displayed the average earning yield of the Standard & Poor's 500 index observed for each inflation expectation category. As shown, there is no correlation between the Standard & Poor's 500 earnings yield and inflation expectation, supporting the hypothesis that earnings yield is a real variable. Earnings yield is a real variable because, as shown by the graph you are observing, it is not affected by inflation expectation. So the Fed model compares a nominal variable with a real one and ignores the risk premium. However, for a certain period, from 1980s to the early 2000s, it worked very well as a predictor of market movements, not only in the USA markets, also in the Italian market, for example. How could that have happened? Why did an essentially wrong model work so well in predicting stock market movements for such a long time? Several explanations have been proposed for this anomaly. If we go back to slide where we introduced the model, that is number 9, we can offer some simple thoughts of why this happened. Observing equality number 7, it is clear that the two errors affect both sides of the equality. One impacts the left side, while the other affects the right side. In fact, the risk premium should be added to the right side of it, while to convert earnings yield into a nominal yield, we should add inflation to the left side. So a simple explanation for why the model sometimes works lies in the possibility that sometimes the two errors may cancel each other. Okay, we can go to number 13. Okay.
Perfect. Before we move, just to give us some, like a little summary. So clearly, Silvio introduced the PE ratio for a stock, which is price per share divided earning per share. Then Silvio explained very well that we can calculate PE ratios, not just for stocks, but also for entire equity index, so the S&P 500. He rightly pointed out that companies in an index can make profit, but they can make also losses, and these affect the index. So some data providers can also provide two different PE ratio for an index with losses and without losses. Then he went through and he said that there was a model, the Fed model, where the earnings yield equal the bond yield, but this was clearly faulted, even if you work for a long series of time, because both sides of the equation were missing something. But the fundamental mistakes here was that there was a nominal value which was compared to a real value, and we looked in the classroom what real and nominal returns are, with the key component being inflation. Another thing which I think is very important is introducing the so-called earnings yield, which is the inverse of the PE. And then now Silvio is going to introduce the new version introduced by Professor Schiller of the CAPE ratio, and why we should take care of these two different values, nominal and real, to really make it complete and more forward-looking.
Okay, before proceeding, let's examine the different methods commonly used to calculate the PE. And after, as said the Professor Zanardo, derived the improved formula provided by Schiller. As I said earlier, an important assumption in calculating the PE ratio is to use a profit value that is representative of company or index normal ability to generate earnings. Analysts generally calculate two types of ratios, PE forward and PE trailing. forward when the denominator is expected profit for the next 12 months, trailing when the denominator is the profit actually made in the last 12 months. The main limit of both ratios consists in the fact that they consider the profit of only 1 year, a fact that exposes the ratio to the risk of being influenced by cyclical factors. During periods of strong economic expansion and therefore of high profits, in fact, PE will be excessively contained. On the other hand, during periods of contraction of the cycle and modest profits, PE will be excessively high. In order to overcome this distortion, Shiller has proposed an alternative method of calculating PE ratio, obtainable simply by using the average earnings of the last 10 years rather than current or expected profits. This was not a new idea. Shiller got it from a famous textbook titled Security Analysis, published in 1934 by Benjamin Graham and David Dodd. Using the average of 10 years of profits rather than a single year allows to obtain an income value that takes into account both good and bad years, obtaining an estimate non-influenced by extreme values. For this reason, the PE calculated by Shiller is called cyclically adjusted price earnings. Since 10 years is a very long observation horizon, profits will have to be adjusted for inflation in order to obtain comparable value in terms of purchasing power. Well, Shiller was able to reconstruct the historical series of the CAPE ratio for the S&P 500 index dating back to 1881. This means that since 10 years of data are needed to construct the indicator, Shiller has reconstructed all the necessary information starting from 1871. His findings shows, and we can see it in this graph, that the CAPE tends to fluctuate around an equilibrium value. In this graph, the CAPE ratio for the S&P 500 index is represented by the blue line, while we use a 25-year moving average as a proxy for the equilibrium level, and it is represented by the red dashed line. As observed, the movement of the CAPE can be predicted. Specifically, when the CAPE ratio is above the equilibrium level, when the blue line is above the red line, the CAPE is likely to decline. And conversely, when the CAPE ratio is below the equilibrium level, the CAPE tends to rise. This leads to the following question: what causes this fluctuation in the ratio? Well, we can observe this graph which represents the CAPE, blue line, and the equilibrium value, red line. Since CAPE ratio tends to fluctuate around the equilibrium value, assuming that this value coincides with the red line in this graph, when CAPE reaches a value like that represented by point A, it will have to fall. Since the CAPE is a ratio, its movements can be driven by either the numerator or the denominator, by the price or by the earnings. But the random walk theory suggests that it is not possible to predict the movements of stock prices. Therefore, according to random walk theory, high CAPE must forecast an increase in earnings. The denominator will move in the direction that restores the ratio to its historical average. For the same reason, when Cape reaches a value such as that represented by point C, according to random walk theory, a decline in earnings will restore the ratio to its historical average. Also, in this case, the denominator, not the numerator, will move the ratio. Well, do prediction of the theory find empirical confirmation? Campbell and Schiller had verified that the factor that drove the Cape towards its equilibrium level in the past was the price, not the earnings. Let's examine the two scatter plots on this slide, which are taken from a paper written by Campbell and Schiller. The first scatter plot illustrates the relationship between Cape and the earnings growth, and the pattern you can observe shows no correlation between the two variables. The second scatter plot examines the relationship between the Cape and price growth, where the observed suggests a negative correlation. Therefore, Cape ratio serves as a predictor of stock price movement rather than earnings growth. First, the historical analysis conducted by, as I said, Campbell and Schiller subverts the conclusions based on the random walk theory. According to empirical evidence, Cape forecasts a decrease in price. The numerator will move in the direction that restores the ratio to its equilibrium level. According to empirical evidence, low Cape forecasts rise in price. The numerator will move the indicator. Therefore, in the real world, movements from point A to point B and from point C to D are driven by changes in stocks. And Schiller joined the conclusion that equity market fluctuates between irrational exuberance and pessimism. Cape ratios are generally associated with excessive earnings growth expectation, and it is what Schiller means for irrational exuberance. And when it happens, Cape is absorbed by equity price decline. Conversely, low Cape ratios are generally associated with unfounded fears of low earnings growth. And it is what Schiller means for irrational pessimism. And low Cape are reabsorbed by rising equity prices. Irrational exuberance is also the title of a famous book published by Schiller in 2000, in which he illustrated the insane valuation that the stock markets had reached during the dot-com speculative bubble. This book gave Schiller some fame among the general public because through his model, he was able to predict the collapse of the stock market as a result of the speculative bubble. And as you know, the stock market crashed shortly after the book was published. So thanks to the Cape, we have a tool, an important tool to understand the market mood. But in this slide, in this scatter plot, we replicate an analysis conducted by Michael Fink and published in July 2020. In his article, the author verified the ability of the Cape to predict the returns of the S&P 500 index for all the decades that began between 1995 and 2010. Each point in the scatter plot represents the S&P 500 Cape at a given moment, measured on the horizontal axis. and the annual return achieved by the S&P 500 index in the following decade, and it is measured on the vertical axis. Well, as you can see, in a period where accounting rule changed, where in 2008 a global financial crisis threatened the very existence of capital, CAPE explained 90% of the variation in 10-year stock returns, and I think it's a great job. The bad news at that time was that using the model estimated by Fink, the level of CAPE, we are in 2020, in that moment, promised a very modest return for US stocks in the next decade. Well, Robert Shiller, the next slide, Robert Shiller, in an article published a few months later, partially contradicted this conclusion. Indeed, despite the high level reached by CAPE, according to Shiller, stocks at that time continued to be attractive. And to support his thesis, Shiller introduced a new indicator. He called the new indicator excess CAPE yield. Excess CAPE yield is a measure of the expected risk premium obtained by subtracting the real yield on 10-year government bonds from the real expected return on stocks that we know is the earnings yield. Well, if you look the formula in the box called RTBY, the real bond yield, and ECY, the excess CAPE yield calculation, is, as you see in the formula, earnings yield minus real treasury bond yield. So we are back to something very similar to the Fed model we observed in the first part of this speech, but without the mistakes that invalidated it. In fact, in this case, the risk premium that a share must offer compared to the bonds is taken into account, and the comparison is made between two real returns, earning yield and real treasury bond yield, and not between a real and a nominal one, as in the case of the Fed model.
Thank you, Silvio. Thank you very much. Let's stop here and recap, because these are really key points to understand, and then you will take us through how you use these in comparing equity markets. So what Silvio Olivero has been saying is that from forward-looking PE, which uses 1 year ahead net profit estimates, or for the trailing PE, Professor Schill introduced the CAPE, cyclically adjusted price earning, by using 10 years of earnings. This because 10 years is a long enough period where you can have some good years and bad years. So from there, he then looked at these charts. Obviously, as we have a 10 years history, if you start 1905, you have to go back 10 years, but he reconstructed, also adjusting for inflation, all of this, and you can see that the blue line is the PE of the S&P 500 index each year, and the dotted line is the 25 years average CAPE, which gives us an indication. Then Silvio took us through the random walk theory, which basically explains how does a high PE like in 1928, 29, before the Wall Street crisis, or just before March 2000, moves back. And the random walk theory is basically saying that it is the denominator, is the earnings that will adjust according to the economic cycles. But actually, looking at some analysis, we then discover that it's not the denominator, the earnings, but it's actually the price of the share which will adjust. So it will fall when the PE is extremely high, or it will rise when the PE is extremely low. And this has to do with some typical behaviors of behavioral finance, where there are moments in the market of irrational exuberance. People think that the stock market will continue to go higher and higher, and they keep buying. And that's at the top line of irrational pessimism. The market tanks, goes down 20, 30, 40, 50%, and people still think it's going to go down more. And actually, usually that's the best time to buy. So it's actually the price that changes, not the earnings. And then Silvio took us through all the nominal and real variables, and on an article published by Finke, what emerged from this variation was actually the adjustment, Silvio, if I can say, of the Fed model. And this is what Professor Schiller came with, introducing the excess Cape yield, ECY, which is the earnings yield, which, remember, is the inverse of the PE ratio, minus the long-term yield, which is also a measure of inflation. So in this way, through this historical journey, we have reconciled a little bit what we've been saying at the beginning of the course: nominal return, real return, why the equity markets can still be attractive, even if it looks a little bit pricey, because you always have to look at the alternative. We saw up until a few years ago that the interest rates were actually close to zero, and real interest rates were negative. So basically, we have Francesco Castelli from Banner Capital the other day. You heard from him that for a number of years, investing in bonds was actually not really interesting because you had negative interest rates. And this, putting together what Mr. Olivero is saying to us today, now you have a much more wider picture, putting together the equity market, the PE, the Cape, the earnings yield, and this comes into the equation, also the long-term assumptions for 10 years yield, which captures the inflation. So finally, we can compare apple with apple, real variable with real variable. I just wanted to underline this, Silvio. One, to sum up what you said, but two, also really to put everything together with the previous lessons, with the bond yield, with the abnormal period we have had in the history of financial markets after 2008, where we had for a very long time negative real rates, which was the anomaly, really, rather than the norm. Over to you, Silvio.
Okay, and this graph represents the reason that Schiller had to contradict the Fink conclusion about the future of the index S&P 500 starting from 2020. The blue line in the graph represents the excess Cape yield of S&P 500 calculated by Schiller since 1881, the same start date of the Cape, while the gray line shows for each year the outperformance of stocks over bonds observed in the following 10 years. As you can observe, high levels of excess Cape yield generally anticipated high overperformances of stocks. Conversely, low excess Cape yield levels were followed by low or negative outperformance. But observing the graph, it's clear why Schiller contested Fink's pessimistic conclusion. In fact, at the moment, in 2020, the excess Cape yield of the S&P 500 index, that is represented by the green dot, was approximately on the average value, anticipating a future over return of stocks in line with the historical average. Today, the situation that is represented by the red dot is very different. the excess Cape yield, in fact, is at a very low level, not far from its absolute minimum, signaling an extremely low risk premium for the next decade. Well, Cape and excess Cape yield are not alternatives because they provide two distinct types of information. Cape makes it possible to predict the absolute performance of the stock market, while the excess Cape yield represents a proxy of its relative performance. Therefore, it is useful to use them together, and we will use them together in the table that I will illustrate now, next one. Okay, here you can find a practical example of how to apply the indicators we have introduced. The table you see is the same one I showed you at the beginning. By now, you should have all the necessary knowledge to fully understand it. In the table, for some of the world's major equity market, the first column displays the Cape. The second shows the 25-year average of the Cape for each market. The inverse of the Cape, the earnings yield that we say is a proxy for the future real yield from stock market, is listed in the third column. The fourth column presents the average real return of each market from 1979 to 2024. So the third and the fourth column compares the expected real returns with the actual real return of each market. The fifth column reports the excess Cape yield for each market, while the sixth shows the historical average of excess Cape yield. All the values reported are the result of internal calculation by Giotto Cellino, my company, and are based on data obtained from the FactSet database. The only exception is the data related to the US market, for which I used the data processed by Robert Schiller, available on his homepage of on the Yale University website, and we will talk about it in the last part of the presentation. How should this table be read? Does it make sense to read it vertically, comparing different stock markets? Well, in reality, cross-market comparisons may be of limited significance due to the difference in sectorial composition. For instance, if the Cape of one market is higher than that of another, it does not necessarily mean that the second market is more attractive. The discrepancy could be justified, for example, by differences in the types of stock that make up the two indexes. Take, so for example, the gap between the Italian market, where the Cape is around 17, and the US market, where it stands up to approximately 38. This difference can largely be explained by the fact that the Italian index contains a higher concentration of stocks from the energy sector, the banking sector, and also the utilities, whereas the US index includes a greater proportion of technology stocks. And as you know, in the energy, banking, utilities sectors typically trade at lower price to earnings ratio than was in the technology. Consequently, the P ratio of the Italian market is structurally lower than that of the US market. And making a simple K comparison between the two is of little analytical value. Similar observation could be made in the comparison between the Cape of the US market and those of all European markets listed in the table. For this reason, a horizontal comparison evaluating each market current data against its historical average is more meaningful. For instance, by examining the figures in the third and the fourth column for a given market, we can ask ourselves, is this market's expected return in line with its historical average, is higher, or is it lower? Using this approach, we observe expected returns in most markets are, to varying degrees, below their historical averages. However, the Italian, British, and Chinese markets stand out as exceptions. Similarly, by analyzing the data in the fifth and the sixth column, we can pose another set of questions. Is the risk premium in line with its historical average, is higher, or is it lower? Looking at the table, we see that in Italy, Spain, and France, the excess cape yield is below its historical level, whereas in Germany it is higher. Outside the Eurozone, the excess cape yield exceeds its historical average in China, matches it in the United Kingdom and Japan, and falls below in the United States. The table, in my opinion, demonstrates that the overvaluation of the US market is significant, both because the expected return is exceptionally low and because the risk premium appears inadequate. This concerning factor is only partially offset by the fact that the European markets, as well as the Japanese and Chinese markets, appear overall more attractive. In the US stock market, in my opinion, we are witnessing a sort of speculative bubble, very different from the one that formed in 2000 with the so-called dot-coms. Today, euphoria is focused only on few technology stocks, whereas in 2000 it affected almost the entire market. For this reason, the cape of the S&P 500 index is currently lower than it was back in 2000. Now it is around 38. In 2000, it joined 45. The reason for this difference lies in the fact that today investors are aware that innovation requires enormous investments, achievable only by a few large companies. In 2000, the narrative was completely different. Disruptive innovation, it was believed, could emerge even from a garage created by a young genius, and sometimes we know it happened. For this reason, in 2000, purchases spread across the entire market, including small cap stocks. I believe this difference is positive for the markets. In fact, unlike what happened in 2000, when investors will eventually abandon euphoria, the correction, just like the rally that preceded it, will be concentrated only on few stocks and should not lead to a widespread crash, as occurred, as you know, I think, in 2000. What has happened with DeepSeek could partially alter these beliefs of mine, given that apparently DeepSeek would demonstrate the possibility of creating an extremely efficient artificial intelligence model with very limited resources. This could open the door to a scenario similar to that of 2000. However, it should be noted that at the moment, the market does not seem to give much credit to this hypothesis. In conclusion, according to the models I presented in this lecture, over the next decade, the US stock market is expected to deliver a modest return to investors, lower than that of most of other global equity markets. Okay, we can have a look of the next slide. Here is represented the excellent research work carried out by Schiller. It is constantly updated and freely downloadable. I said you that the data used for the S&P 500 was taken from the Schiller database and not from our database. It's freely downloadable from his personal page that you can find in the Yale University website, and the link is reported at the end of the presentation. Here you can see an example of the Excel file you can download. It contains the data you can download from Schiller database. The column shows all the data necessary to carry out the calculation for S&P 500, the nominal level of the index, the US CPI, nominal and real earnings per share, bond yields, all you need, and all formulas used are visible inside the Excel cells. For example, in column M, you can read the formula for the CAPE, in column Q, the formula for the excess CAPE yield. Additionally, in the file is included a corrected version of CAPE known as the total return CAPE. The total return CAPE adjusts for biases introduced by recent changes in corporate payout policies. In the US, share repurchases now are largely replaced by have largely replaced the dividends with stocks repurchased by the company, and the shift may impact the growth rate of real earnings, and consequently the average real earnings per share. So Schiller elaborated a new improved model called total return CAPE to account this potential bias. And you can find also the calculation for this model. So I think this is a very interesting for you to download this file and do some experiments. I think you will find it very interesting and useful. So I have concluded my speech.
Thank you very much, Silvio. Before opening to any kind of question from the class or via online Zoom, just go back to some key fundamental points that you have brilliantly introduced. This is, if you want, kind of a summary table. So the first thing we should notice, like Silvio mentioned, is that if we read the table vertically, it doesn't make a lot of sense, or it doesn't really tell us much. Also because as we started the lessons, you need to be aware of the structure of each equity market. Like Silvio said, in the US, both in the NASDAQ Composite and in the S&P, the weight of technology companies, AI-related technology, is very high. They are typically companies with a higher growth, and hence they trade at higher PEs. And that is why if a market is more geared towards technology or higher or growth stocks, it doesn't really make sense to compare on its own Italy, which is a market made mostly of banks, utilities, and energy companies, which are cyclical, defensive, and hence trade a lower P with a market. So you should not focus. What this table gives us is two things. A, an historic perspective across markets and between markets, which is how you should look at it. And B, the comparison of apple with apple measures throughout the years and throughout the cycles. So if we can go back just on, for instance, this slide, like Silvio was saying, you can see that in the dot-com bubble or internet bubble, which deflated in March 2000, it was in Italy, it was in the States. As Silvio was pointed out, at that time, the PE ratio of the market was higher than today. And at that time, the entire market was very expensive. If we were in a, we can tell us now, because then the market can, we were in a situation of exuberance, irrational exuberance. Any stock that had a technological label on it was deemed to make future profits very high. Then reality became a harsh reality, and the market deflated. Whereas today we have 7, 8, 9 stocks, which are actually the one that make up, what is it, 33% of the index today, roughly 33, 34 of the S&P is made by the 7 companies. But the rest of the market is not so expensive. So going back to the table and looking at this graph, it is really important to understand A, how the table is constructed, B, do not measure the table just market to market, but have an historic perspective within markets and across markets, and understand also the variables which are implied. And this is what will give us additional tools, probably to try to guess future movements, longer term, where the index is going and hence the market is going, or where some markets are priced more attractively over the medium term, and maybe we should rebalance our portfolio. Now, starting from the classroom, any questions, not just related to CAPE, of course, but even to real life example or equities or portfolio, any kind of question you want to ask to Silvio? Okay, sure. So there is a question from the room which says, is there any kind of method to normalize the S&P index excluding the Magnificent Seven and see where it trades?
Well, I think it is possible. I didn't try to do it, but S&P 500 index is a simple capitalization index, so you can reconstruct it excluding the stocks you intended to exclude, and construct so a corrected index that, for example, exclude the 7 most important stocks. It is interesting answer, pardon, question. But it is possible. It's very, very easy, I think, because if you see the formula that represents the wave of calculation of PE ratio of an index, you just have to exclude the stock you want to remove from the index. I don't know if you can show the slide in which is presented the.
And I was trying to go back to the presentation, so if I find it, and but basically, like we said, if you remove the 7 stocks, their market cap divided by the earning per share, then you get the rest. So it's what we looked at.
In the example, we consider a free stock index, no? A stock A, stock B, and stock C. If you want to exclude the stock A, you just have to exclude from the numerator the profit of stock A, from the denominator the earnings of stock A, and you have a new index with just 2 stocks. And you can do the same exercise with the stock 100, with the S&P 500 index. You can, okay, is there. Okay, if you want to calculate an index that just consider B and C, you just have to exclude from the calculation in the numerator 10 millions of capitalization, and in the denominator 1 million of the earnings. You have to do this for a long period, because you have to reconstruct the historical series of the S&P 500, excluding the 7, if you want, 20, 30, 40 years, and it is a simple exercise in theory. In practice, you have to manage a lot of data, but it is possible.
Are you expecting a contraction in the stock market given the CAPE indicator hinting at an overvaluation? Have you heard it?
Yes, I heard. Yes, a correction in stock price, I think, is inevitable. But the CAPE say that it is necessary that the price correct, but the limit of the model is that CAPE doesn't say us when it will happen. And it was, I said before the lesson with Professor Zanardo, I'm quite positive about markets for the next month. It's because the fact that US market is overvalued is not sufficient to say that the market will correct in the short term. But in the long term, this overvaluation must be corrected. As we saw, the correction, the CAPE is moved by the price in the long term, not by the earnings. So the high level of CAPE we are now observing, in my opinion, doesn't anticipate an exceptional growth in earnings for the index. I think it is anticipating a crash in the price. But as I said, the correction will involve just few stocks, very heavy in the index, but just few stocks. And it will be the difference between the bubble we are observing now on the market and the bubble we observed 25 years ago in 2000s during the dot-com bubble.
Maybe if there are some sectors where the price to earning ratio is more useful and more explicative. Sure.
Are there any sectors where the PE ratio tends to be more useful, more explicative, or it's pretty much a general application to all sectors?
Well, I prefer, and you saw it in the table I prefer to use a CAPE ratio, the CAPE ratio for national index. So I don't use it for sectorial application, but Schiller and our author use it also for sectorial analysis. It is mentioned in the last part of the presentation. You can have a look not only at the Schiller homepage in the Yale University site, but also in the site of Barclays Bank. There are many data about CAPE index and the Schiller observation, because Schiller is now in a partnership with Barclays Bank, and they are producing also analysis on industrial sectors. But I believe that the best application of the model is the original one, and is for more diversified index that represents national economy, not just a single sector. But it is possible to use the model with a sectorial view, and you can find a lot of material in the Berkeley site.
So there is a question here from the room, Silvio. Basically, by extrapolating from the PE ratio and try to get a target price from a target PE using the same formula of the PE. Any comment on this?
Once I projected earning per share.
Once I project, so I have a model which projects the earning per share going forward. I think we go through the dividend discount model, which basically we go before, but I'll let Silvio answer this question.
Yes, the question is if is it possible to use PE ratio to make a target price, to
Yes.
obtain a target price for a stock?
Yes, that's the question.
Yes, the answer is yes. It is used to in this way. You have to choose if to use a correct multiple or a correct earnings, or you can use altogether. Well, I mean, do you have an estimate for the EPS of a single stock? Okay, you can use it, and you have to have also a correct multiple. So
Yes.
you can use, for example, the average. Stocks A has an EPS of 0.5 euros, as in the example. At the market price, say does that the P ratio is about 20, but you can have your reason to think that the current multiple is 25, and so you can affirm that the target price is 25% higher than the stock market price.
Yeah, so the variables are two, just to be pragmatic. One is the EPS. You can forecast earning per share, which is different from the consensus. And if you are more bullish for your own reason, your EPS is higher, then it's good for the stock. And the second variable is the multiple, the level of PE. For instance, if you think that 38 PE of the S&P should be used because the stock is a technology stocks, and you think that we will keep having a higher market, and you use 38. But if you think for whatever reason we should take the 25 years average or the average PE, that's the second assumption you make.
Yes, as said Professor Zanaro, you can use an approach similar to that we have presented for the Cape. Now you can use the average price earnings of last 20, 25, 30 years and use it as a metric to determine the target price using the current or the expected earnings. But the mean reversion of price earnings is an observation that is true for indexes, but is also true for single stocks. So the way to find the true multiple would be the way to choose the average, and to use the average of the multiple with an earning per share that you can choose from the consensus for your own projections or where you want.
So at this point, really, I think it was an extremely interesting lesson, putting many concepts together and giving us a perspective. We thank Mr. Silvio Olivero, Head of Research and Equity Manager at Giotto Cellino SIM, and of course Giotto always giving us his time to us, and we will publish once it is edited and viewed, and we'll make it available to Giotto as well, the video. And then with Giotto consent, if upon request we can share the presentation to interested students, I would be delighted to do so, assuming Giotto is okay with that. But not just upon request, individual request. So thank you so much, Silvio. Thank you all, and we'll see you soon. All the best.
Thank you.
Bye. Bye.
Bye.